Hey, welcome. Today we're going to talk about something most people dread taxes. But we're going to look at it a little differently. Not as something you just have to pay, but as a set of rules, a blueprint, really, that actually shows you how wealth is built and protected in this country. And it all kicks off with a question you've probably asked yourself.
You hear this all the time, right? How is it possible that someone earning millions can have a lower tax bill than someone earning a fraction of that? Is it some secret loophole? Is the system just rigged? Well, what if it's not about cheating the game, but about understanding that there's a completely different game being played? That's the puzzle we're digging into today.
So here's how we're going to break it all down. First, we'll look at the two very different tax playbooks that exist. Then, we'll get into the mechanics of something called the paper loss engine. After that, we'll see how you can connect that engine to your main income. We'll explore the long-term game plan for investors. And finally, wrap it all up with a big shift in mindset, from being an earner to becoming an owner.
Okay, let's start with the most fundamental concept you need to grasp. The tax code treats people differently based on how they make their money. It's not really about how much you make, it's about where that money comes from. And this one distinction creates two completely different financial realities. This slide really lays it all out. On the left, you've got the employee playbook. It's a one-way street. You earn money, you immediately pay taxes on it, and then you spend what's left. Simple. But now look to the right. The investor playbook isn't a straight line at all. It's a loop. You acquire assets, those assets generate income, you use the tax code to protect that income, and then you use it to buy more assets. Understanding this is everything. So why does this second playbook even exist? Here's the crucial insight. The tax code isn't really designed to be a punishment. It's actually a system of incentives. You see, the government wants people to do certain things that are good for the economy, like providing housing or creating businesses. And to encourage that, they offer huge tax breaks as a reward. It's almost like a partnership. All right, if the tax code is full of incentives, which one is the most powerful? Well, that brings us to the very core of the investor's strategy, something we can call the paper loss engine. It's this wild concept that lets you legally show a loss on paper for tax purposes, even while your asset is actually growing in value and putting cash in your pocket. This quote right here just nails it. It sounds completely backward, doesn't it? The government is letting you claim a loss on an asset that is in all likelihood going up in value. This whole paradox is the secret sauce. It's the investor playbook in its purest form. So what is this magic trick? It's a concept called depreciation. And no, it's not a real loss. No money is actually leaving your bank account. It's a non-cash expense. Basically, the government lets you deduct the supposed wear and tear on a building structure over many years. This creates a loss on your tax return that can be used to cancel out your real taxable income. And just to give you a sense of the scale we're talking about, look at this. If you buy a property where the building, not the land, just the building, is worth $1 million, the tax code lets you write off that entire $1 million against your income over time. This isn't some tiny little deduction. It's a massive foundational part of the system. Now, waiting 27 and a half years to get those tax breaks is, well, it's the slow lane. And savvy investors, they don't like the slow lane. They have a way to pull a huge chunk of those future deductions forward into the first few years they own the property. They basically supercharge the engine. And the tool they use to do this is called a cost segregation study. It sounds complicated, but the idea is simple. You hire engineers to come in and break the property down into its component parts. Things like carpets, light fixtures, cabinets. Since those things wear out faster than the whole building, the government lets you write them off way sooner, giving you a giant paper loss right up front. Okay, now we get to the part that is a complete game changer for people with high-paying jobs. It's one thing to have a big paper loss from your real estate, but it's a whole other level to be able to use that loss to wipe out the taxes you owe on your main salary. But there's a catch.
The IRS puts up a kind of firewall. They generally say that rental income is passive, and that means you can only use those real estate losses to offset other passive income. They specifically try to block you from using them against your active income, like from your job. So this is the million-dollar question, isn't it? How do you tear down that firewall? How do you connect those huge paper losses from your property directly to your W-2 income and slash your tax bill? Well, it turns out there is a key, a very specific key designed to unlock that gate. And here is that key, the short-term rental. If you operate your property more like a business, think Airbnb or Vrbo, where the average guest stays for 7 days or less, and you are actively involved in running it, the rules can change. Suddenly, it's not a passive activity anymore, and that firewall, it comes tumbling down. So what happens when you combine these two strategies, a short-term rental and that accelerated depreciation we talked about? The impact is just staggering. For high-income earners, this combination can potentially reduce their entire tax bill by 50 to 70%. It is an unbelievably powerful tool. So you figured out how to win this year's tax battle. That's huge. But the truly wealthy are always thinking about the long game. They're focused on the war, how to preserve and grow that wealth for generations with as little friction from taxes as possible. And a massive piece of that puzzle is simply focusing on the type of income you generate. Just look at this chart. The tax rate on your salary can be almost double what you pay on profits from an asset you've owned for more than a year. Investors are obsessed with generating long-term capital gains, not just W-2 income. But here's the ultimate pro move. The most sophisticated investors try to access their wealth without selling their assets at all. Instead, they just borrow against them. They go to a bank, use their real estate or stock portfolio as collateral, and take out a loan. And here's the genius part. A loan isn't income, it's debt, so it's completely tax-free cash. And this is the final piece for creating generational wealth. It's called the step-up in basis. When you die and leave an asset to your kids, the IRS essentially hits a giant reset button. All the taxable gains that built up over your entire lifetime are just erased. Your heir inherits the asset at its current value, meaning they could sell it the very next day and pay zero tax on all that growth. It is the ultimate wealth transfer tool. So as we pull this all together, you can see that this is so much more than just a collection of clever tax tricks. It's really about a fundamental shift in how you view your entire financial life. It's about moving from one mindset to a completely different one. So let's just recap the whole path. It all begins with step 1. You have to understand that the tax code is a game of incentives. Then, step 2, you take action. You build that paper loss engine, probably with real estate, to slash your taxes right now. And finally, step 3, you play the long game, using smart strategies to preserve that wealth for years and years to come. Look, if there is only one thing you take away from all of this, let it be this right here. The game completely changes the moment you stop focusing only on how much you earn and start focusing on what you own. It's a shift from being a high earner to becoming a strategic owner. So, in the end, it's pretty clear. The tax system lays out 2 very different playbooks with 2 very different sets of rules. Most people only ever learn about the first one, but now you know that both of them exist, so the only question left is, which one are you going to choose to play by?